Alrighty. Uh, hey, good afternoon, everyone. So we are going to get started in next minute or so while we are waiting for more folks to join us today for this webinar. Let's get to know more about each other. Drop your business name and what you do in the chat box. I would love to see who all are there with us in this webinar today. And I'm going to share my screen as well. Okay, please let me know if you're able to see my screen clear. Awesome. Okay, we are starting with the webinar. Again, welcome to today's webinar, Meet the VC with Demi Obayomi from Sapphire Ventures, presented by Early Growth. My name is Kushbu. I'm an event marketing manager at Early Growth, and I'll be your host for today. A few housekeeping notes for you all. This webinar will last approximately 60 minutes, 50 to 60 minutes, including the time for Q&A at the end. You can place your questions in the Q&A panel at any time. This webinar will be recorded and sent to all registrants within 48 hours of this presentation. You can also find this recording and all of our previous webinars recording on our YouTube channel. The link to it will be sent to it with the recording email. Something about us. So before we get started, let me tell you about Early Growth. At Early Growth, we have got entire finance stack covered. What it means is really two things. First, you have got a strategic partner in your growing business. Our CFOs, with their years of experience and dozens of startups under their belt, help you see what's coming, be it good or bad, and take advantage of it. From strategic decisions to fundraising, they have seen it all before. Second, our CFOs, senior accountants, and tax advisors take care of all of your blockings and tackling related to the day-to-day, month-to-month, and year-to-year of your finances so that you can focus on your business. Both Early Growth and our CFOs have been around the block a few times. We have helped and served over 5,000 clients coast to coast and around the world, approximately 40 countries. As always, our CFOs have helped our clients raise billions of dollars. We would love to help you and serve you as well. So what we believe in delivering peace of mind for providing you all one-on-one solutions for your needs, requirements, including CFO services, HR, accounting, taxes, and insurance. We'd like to protect your profitability by giving you a sole point of contact to answer all kind of questions and strategic dashboards to help you understand your business and company better. We want to be your partner in growth to help your business grow by we working in the back end so that you can focus on the growth side of your business. So we have a promo running. I hope you must have already started with planning of your 2020 taxes already. And if you haven't, or you want a provider in place before the end of the year, so you can focus at the effective tax planning before the year ends. We have a promo running to help you with that now. You can get $500 off your 2022 tax preparations. So guys, it's the deadline for 30 days. You can log into our Early Growth website and look into for more details. And so just to kick us off, I want to introduce a quick poll of questions to see who all are in the room. The poll will be starting in 30 seconds now, and it will be up and running until the end of the webinar. You must be able to see the poll on your screens, and you can fill it at any time based on your convenience. Okay, so about our partners, your team is critical to your success, and that's true whether you're building a startup or putting together a great webinar. We have got a number of great partners in the startup community, but for today's event, it's the best of the best. Early Growth has always focused on the team, the community. We know that together we go further. To bring you today's webinar, we have a startup dream team. And to tell you more about our partners, we have our moderator, David Mashudi, with us. David has been a business development manager with Early Growth for a little over 3 years. Prior joining to Early Growth, David was financial analyst at VIIP Capital. In his spare time, David likes to hike and even through hiked both the Pacific Crest Trail and Continental Divide Trail in their entirety from Mexico to Canada. Before we proceed, just a reminder, if you have any questions for our VC, please put them in Q&A window, not in the chat. So now, here to introduce more about our partners and to take over, Mr. David Mishudi.
Thanks, Kushbu, and thanks everyone for joining. Hi, I'm David, as Kushbu gave me a lovely introduction. We couldn't do this without our partners, so I wanted to take some time to let them introduce themselves. First, I'll start with Jacqueline from Trinet. Jacqueline, do you want to say a few things?
Hi, everyone. Jacqueline from Trinet. We work with early stage, mid-stage companies in HR, people. After payroll, basically retention, HR is the second most costly thing in a company. A lot of companies are reevaluating for the new year. This is the busy time for us. So if you're currently offering benefits or planning on raising and turning on the switch once you get that round of offer benefits, please reach out to me. We do have a partnership with Early Growth Financial, and we're here to do a benchmark analysis for you and see if you guys have.
Awesome. Thank you, Jacqueline. Really happy to have you here. Also would love to introduce Stan from Pillsbury, one of our trusted legal partners. Stan, go ahead and introduce yourself.
Good afternoon. My name is Stan Lewandowski, and on behalf of Pillsbury, I'd like to welcome all of you to today's webinar. I will also quickly share a few words about who we are. Pillsbury is an international law firm with a particular focus on the technology and media, energy, financial, and real estate and construction sectors. We provide legal advice to companies of all shapes and sizes, from newly formed startups to Fortune 100 companies. My partners and I enjoy collaborating and, as a result, providing the most optimal practical legal solutions to our clients' real business needs. Since we practice in the US, Asia, and Europe, you can find us on almost 20 different places around the globe. So once again, welcome and thank you.
Thanks for coming, Stan. Yeah, really enjoy working with Pillsbury and happy to be partnered with you on this event again. Another partner of ours is Vistra on this. Unfortunately, they weren't able to join due to the SaaStr conference that's happening right now. But if any of you are in need of expansion support, any of you going overseas, Vistra certainly is a great partner when helping accounting and tax compliance internationally for a lot of our clients. So with that, would love to introduce our guest speaker today. Demi Obayomi is here today from Sapphire Ventures. Really excited to have him join us. And I know you're joining us from SaaStr today, Demi, so thanks for stepping away and making some time for us.
Of course, happy to be here.
Yeah, so first off, I mean, I'll give you an easy one. Would love to hear how you got started in VC. I mean, I'm looking at your background and looks like you got your foot in the door with Goldman as an investment banker initially, and then just looking at your portfolio work, whether it's with A-Level or Next World or Firstmark, excuse me, and then now with Sapphire, a number of really interesting and successful investments over the years. So would love to learn how you got started and how your evolution has progressed over the years.
Yeah, absolutely. I think, it really goes way back to when I was in college. I was a sophomore in college, and I started a company when I was in college, and we needed to raise money for that company. And that's kind of what led me to go talk to investors. So I went to talk to a group called the Drum Room Fund, which is basically, back then, they were a group of students in Philly at UPenn who were investing in ideas started by other students. And that's where I really just kind of fell in love with venture, because I was really blown away by this concept of, students backing the ventures of other students. And they have pretty much full decision-making power on what to invest in and what's not invested in. And so that really stuck with me. And I wanted to do something like that for Johns Hopkins, where I was going to school. Johns Hopkins is in Baltimore. There's really no venture capitalists around. Venture capitalists live in mostly other major cities. So I started A-Level Capital to basically be a fund run by students to invest in the Johns Hopkins community. And when I left that, I came to the Bay Area. I spent a summer working at 500 startups. And I think that's where I really kind of like committed to spending much of my career in venture, because in the Bay Area, I got to immerse myself in venture capital, immerse myself in technology. And even though I had this job to go work in investment banking, I knew that I wanted to make my way back to venture capital as quickly as possible. And so after my investment banking analyst program, I joined Firstmark Capital in New York, and then was fortunate to have an opportunity to come to the Bay Area and join Nextwall before joining Sapphire in 2021. And at Sapphire, we primarily focus on kind of like post product market fit companies. So sometimes that could be at the Series A or B. Other times it might be a little bit later. We have like the Series, C or D round, or some of the other kind of.
We lose you, Demi. We'll let him jump off and jump back on. I'm sure we'll get this sorted out. He was just getting to the good part, what he likes to invest in and what the fund does.
Let's wait for a couple of minutes.
Yeah, apologize for the delay. Let's give him a few minutes to jump back in.
He's
And while we
here.
have this time, if anyone wants to put any questions in the chat, I'll keep an eye on it through the webinar, and would love this to be an interactive session as well as we dive in. Sorry, Demi, you there?
I lost I'm back. Lost the connection, but I'm back.
No,
But yeah, I was just basically giving an example of the investments you make at Sapphire.
Yeah, no, I think that's right where we lost you. And that's actually a great segue into my next question, right? Like, even though I'd hope a lot of the folks here have done their homework on the fund, would love to learn. I think that's right where you cut off, was what's the investment thesis? What type of companies at what stage do you like to look at? Give me kind of the overview on Sapphire itself.
Absolutely, yeah. Our investment thesis, what we're looking for is what we call companies of consequence. And basically what this means is that we're looking for generational technology software companies. We've been fortunate to be part of some of those in the past. Companies like Monday.com that I mentioned went public last year. Braze is another company that went public last year as well. 23andMe, and and several others as well. If you look at our current portfolio, there's a lot of companies in there that some of you on this webinar might be using, companies like Pando and Outreach and iSpot, and others too. So we're really looking for companies that we believe will just kind of gain this widespread adoption across industries, whether it's technology or financial services, or retail, whatever the industry category might be. And so we'll invest in these companies globally, so across North America, across all of Europe. I have several colleagues who are based in the UK and really help to drive that effort. We also invest in companies based out of Israel. We have several portfolio companies in Israel currently, and we've also invested in companies in places like Australia, India, as well. So we're a global investment firm at this point. And at a high level, we basically like split the world up into four categories. One is application software companies, and these are basically things like HR software tools, sales software tools, marketing software tools, and so on and so forth. And they're typically used by business users. And then in the second bucket is what we call the infrastructure bucket. So that includes things like developer tools, open source software, data tools, as well as some cybersecurity tools as well. And then we've got fintech and crypto. And across all these four buckets, we invest. Our investment focuses on B2B companies in all of these different buckets. So, and stage-wise, like I mentioned, the stage definitely varies. Like we partner with some companies as early as Series A, we partnered with some companies as late as the Series D, and even later than that as well. But ultimately, what we're looking for is just some signs of product market fit, right? Signs that some signs that if you invest in the go-to-market side of the business, this is a company that can scale pretty rapidly and continue to take up market share. We're looking for companies with a big TAM. Just because, of course, for a company to be a generational business, there has to be a massive market, out there for the company to go out and capture. And then, some standard things like, of course, we're looking for very strong founders who have some prior experience in category and are able to attract the best talent, attract the best, customers as well to their businesses. And yeah, we typically will spend a bit of our time analyzing like the SaaS metrics, talking to customers, just to make sure that all of those things also check out. But that's a quick, kind of summary of some of the things that we do and some of the categories that we invest in.
No, I love it. It's definitely a broad range of focus, and especially I think a lot of the VCs that we talk to are really only investing into US companies. So I think it's really exciting that you have the appetite to dive in and focus on some businesses that are based overseas. That's amazing.
Absolutely.
And I know you're focused on, mentioned Series A to Series D and maybe even beyond. I'm looking through your LinkedIn. I see that a lot of the investment that you made at Sapphire have been kind of in that C and D range. What do you see as like being the biggest differences between, evaluating a Series A company versus a Series, C and beyond company?
Yeah, I think a lot of the things that we look for are similar from like a conceptual basis, right? So we're still looking for a strong team, which that's not really going to change much between a Series A and D company. We're looking for a large market. There will be some evolution in the market, right, over time, because again, by the time you get to Series D, you might have launched new products, which means you have a different market that you're going after. But at the end of the day, we're looking for a pretty large total addressable market, that the company can go and execute after. Then thirdly, we're looking for just the best product, right, in that space, the product that has the most competitive advantages. And there are some differences between Series A and D, because at Series D, it could be much clearer which company in a competitive set or competitive landscape has the edge over others. But sometimes you can also suss that out at the Series A as well. And then the financial metrics. So certainly at Series D, Series C, there's a lot more financials that you have at the stages than you have at the Series A. And then we do a lot of customer calls, right? We like to talk to people who use the product and get their insights, get their perspectives, on the product. So at Series D, those conversations could be a bit more substantive, because you might have customers that have been using the product for years now, and they've evaluated all the other competitors, so they can actually truly speak to why they picked your product versus a different product. Whereas at Series A, the market may not be as evolved, the competitors may not be as established. So people might just buy the first thing they see, but they can't really tell you whether it's better than something else that's out there, on the market. So those are some of the differences between Series A and Series D. Overall, you definitely have more information, of course, at the Series C or D than you have at the Series A. But you pay dearly for that information at the Series C or D, compared to what you would be the valuation you'd be investing in at a Series A.
Yeah, and it seems like the customers that you're dealing with at that later stages, to your point, are probably a little bit more educated and can give you some clear feedback on why the product is so valuable and why they chose it over a competitor. That's awesome. I know the audience is probably more on the seed to Series A side in the room right now. So when you're evaluating one of those investments, first off, like what is the average ticket size? How are you guys typically leading rounds? I would imagine. Do you, how does follow-on investment typically look like? And then walk me through a little bit about like what your diligence process is at that, let's call it seed and seed to Series B stage.
Yeah, so we lead a lot of rounds, but then we also have flexibility to participate in a round. Just we're very founder friendly. We want to do what's best for the founder. We want to accommodate whatever preferences the founder has when they're fundraising. So that might mean they want us to come in alongside another investor. So for example, I invested in a company called Yellow AI, and we co-led that round with another investor. Sometimes founders, they want to work with another, maybe they already signed the terms with another investor, but they also want us to be part of the round. And so maybe we'll participate, in those kinds of rounds with the view to, building up our stake over time in that business. And then, there are many cases where we just straight up lead the round ourselves and, have the insiders maybe do their pro rata investments into the round too. So we're quite flexible on whether we lead, whether we co-lead or participate in the round, depending again on what works best for the founder. And then, when it comes to ticket sizes, so definitely it's going to vary. We don't really do much seed investing. We do a little bit of Series A investing. And then from Series B onwards is where you're going to see the majority of our investments. But we have, again, flexibility on the check size. On the low end, we provide as small as a $10 million check. And on the high end, we provide as much as like a $100 million check, right? So, of course, the $100 million check is going to be for the much later stage companies, and the $10 million check is going to be for the earlier stage companies. And then, diligence process wise, typically what that's going to look like is we're going to have some initial conversation with the founder. That could be at a conference like SaaStr that I'm currently at. That could be just over a Zoom call, like first meeting wherever the founder might be based. And then from there, it depends. Let's just assume the founder is fundraising at that point. We'll probably get some diligence materials from the founders. Maybe we'll get a deck, get some financials from the founder that we can start analyzing and coming and getting up to speed on. And let's assume all those financials checked out. They meet all the different kind of criteria that we're looking for. We'll be doing some customer calls in parallel, so we understand what customers say, why they pick this particular product or not. And then from there, assuming again everything checks out, we'll then have the founder. We'd like to have founders just meet our entire team and have the entire team get to ask their own questions of the founder directly, so they can hear from founders. And so we'll have the founder pitch our entire investment team, our partners, our vice presidents, our associates, just the entire group, so everyone can actually, everyone can actually see the founder, ask the questions they have, understand the product, the company at a much deeper level. We'll also have our portfolio services team speak with the founder just to share, again, what we offer when it comes to connecting them to executive talent, connecting them to potential customers, connecting them to potential partners, helping them expand from the US to Europe or to elsewhere as well, which we do a lot of with our portfolio companies. Because again, I mentioned we have a team out in Europe. And so we'll do all those things again, just for the founder to get to know us as a firm, so just going beyond maybe the 2 or 3 people that are helping to run the deal, to actually get to meet our entire team, our entire portfolio services team. And then, from there, we'll ultimately have some kind of vote on whether we should make this investment or not. And then we have, we issue a term sheet to the company, and then the process kicks off from there to close the investment. So yes, so that's kind of that's sort of the process end to end. And then post investment, we like to say that post investment is where the real work begins, right? Of course, you do all this work to get the deal done, but then we're long-term investors. We're going to be working with companies for the next decade or more until there's an eventual exit. And so, and frankly, we'll back a founder again. So sometimes the relationship with the founder for the last 20, 30, 40 years, just depending on how many companies that they start along the way. So, the 3 or so months, 2 or 3 months that you're spending kind of closing the deal is really just like it's like 1% of the journey. The real work starts afterwards for us.
That's an excellent segue to my next question, because I was going to ask, like, how do you stay involved and how involved are you, right? Like, probably require a board seat. And then what is like, what programs do you offer? Disproportionate value do you like to provide, to your portfolio companies? Can you walk me through and give me some kind of tangible examples of that?
Absolutely. I would say like flexibility has been just very helpful to us. We want to work with the founder to do what's to basically do what's best for them. And different founders are very different. Some founders have a ton of experience. This is their third company. Some founders, this is their first company, and this is what they would like from an investor. So we can take a board seat, we can take a board observer seat as well if that's the founder's preference. Again, depending on the dynamics of the company at the point that we partner with them. And then from an involvement perspective, of course, we'll be very involved regardless of whether we're on the board or not. We'll have sort of one-on-one calls with the founder every couple of weeks just to make sure that they're getting our perspective on how the business is doing, what's going on in the market. We can and see what ways we can help support them on that journey. So we'll we don't just invest money and then say talk to you 10 years later or something like that. We're very on a month-to-month basis. We're engaging with founders in the portfolio, and then like I mentioned before, we have this portfolio services team, and they do a variety of things. One of the things they do is kind of everything related to executive talent, or even just talent more generally. They'll help founders and heads of talent with their talent strategy. They'll introduce them to people in our network who be potential fits for open roles at their company. And then we also have a business development team internally. They work with every single company in our portfolio on introducing them to the right customers, introducing them to the right partners. They'll organize summits and conferences and dinners and all kinds of things like that to make sure that all of our portfolio companies get to interact with potential customers, whether that's a Fortune 500 company like Johnson & Johnson, Restaurant Brands International, Square, McAfee, Citrix, and so on, or whether that's a growth stage company that's in our portfolio that we can easily make a connection for them to. And then we recently added a partner who focuses on revenue excellence, and what that means is essentially he works with our founders and also our go-to-market executives in our portfolio companies on helping them to refine just their go-to-market motion. He's been a go-to-market executive himself, and he can really take a look at your business, take a look at your go-to-market function, and provide you with several pointers and essentially consult with you on maybe some things that you can tweak, right, to really get that extra amount of performance out of your go-to-market engine. And we have several advisors as well that we can use our portfolio companies to get advice from a CRO who scaled a company from 0 to 200 million, advice from a former CMO who's again scaled a business from 0 to hundreds of millions, taken the company public, sold the company to Salesforce, and can really advise our portfolio companies on every step of that journey. So where capital is really just the beginning for us. You get the capital, you get the investor, you also get the entire firm. So all the other investors on the team will also be supportive of every single portfolio company. And then you get the entirety of our portfolio services team as well. They do I think maybe one final thing to highlight is that, again, since we have a team out in London, one of the things our portfolio services team does is they help companies that are looking to expand from the US to Europe. And they have several, our portfolio services team has tons of relationships in Europe. They'll introduce you to customers and partners out there, as well as talent, right? That's actually set up, businesses in Europe for US-based companies that could help you kind of drive that initiative too. So there's a ton of stuff that we can help companies with. It's all bespoke and custom to what that particular company, what that particular business needs.
Yeah, that's amazing. I mean, it's not just the capital, to your point. Once you have the consensus of the whole fund, it really seems like you guys provide a lot of value aside from that initial money. And then I would imagine are sticking around and following on for additional rounds and being kind of leading that charge as well as things go forward all the way to an exit.
Yeah, we follow.
So
we invest. In fact, we might lead a round, and then we might lead the next round as well too, because again, we have such a big fund that gives us that capacity. Regardless, we certainly reserve capital to follow on in multiple rounds, even all the way to the IPO. We were investors in Monday.com, and we committed at the IPO round as well to that company. So probably taking our total investment in that company upwards of $100 million across multiple rounds. So we're extremely supportive of our portfolio companies. There's just so many examples of cases where we've stepped up to the plate to back a portfolio company again and help them on their next leg of the journey.
Yeah. Well, I do want to keep an eye on the chat box, and I have a couple of questions here. One of which, so for a $10 million round, what would be the valuation? I'm guessing that's like 60 million posts.
There's no cookie cutter, right? It's going to be a negotiation between you and the folks that are investing at that particular round. Just to give maybe some pointers, I would for a traditional venture investor, I would say that a 10 million round is probably going to get you anywhere from like a 25 to 30 million, maybe on the lower end to, yeah, it could be upwards of 50 million, on the higher end.
Yeah, that makes sense. And then got
But yeah,
another
it's very
question.
specific to the business.
100%. You got to look at the multiples and really negotiate the value with the investors. I would imagine it kind of ranges depending on the business for sure. One other question, how are investors currently looking at safe rounds as opposed to equity round markets? So much earlier stage of investment, but given the changes in the current landscape, like what's your advice for an early stage fund founder in terms of raising that first round, giving away equity, or potentially going with something more less dilutive initially?
Yeah, for us, we primarily invest in just traditional equity rounds because we might go as early as like a Series A, and at that point, you're definitely doing a price. You're definitely going to price your Series A. It's usually before the Series A, like if it's a pre-seed or seed round, that's where you see some people maybe raising the round on a safe note, and then sometimes like in between rounds, like between a Series A and a Series B, someone might use a safe note. Most of the rounds that we're dealing with are just going to be priced equity rounds. You're going to see priced equity rounds in cases where either there's a lead investor who has a lot of conviction, wants to be very involved, and therefore they want to provide clarity, right, on how much everyone owns in the business, because sometimes it saves you run into an issue where no one really knows how much they own, and then upon sometimes founders will raise multiple safe notes on different terms. And when you convert all the safe notes, suddenly the founder is shocked by how little they own of the business after the dilution effects of all those safe notes. So there's a huge debate about, safe versus price rounds, and you can definitely go online and kind of read more into that. But for our stage where we play, it's going to be primarily price rounds. And again, the benefit of that is you just get a lot more, there's just clarity on all sides on how much everyone owns, how much everyone's buying. But I totally get why people use safe notes earlier in like pre-seed or seed. Sometimes it's more flexible, right? It's cheaper. There's definitely lots of good reasons to do it, and people definitely still, do those in the early stages today.
Yeah. Back to kind of what we were talking about with Sapphire, we talked about the value you add, post investment. Can you give us some examples of kind of pitches that you've heard or things that stand out to you for a successful founder, for pitches that you really enjoy? And then conversely, what are some of your pet peeves when doing pitches with founders? Like, what are the things that stand out to you that can quickly turn into a red flag versus, what really sparks your interest when you hear a founder come in and kind of nail a pitch?
Great question. I would say, and it really is on both sides, right? I think sometimes it's both the founder and the investor have to be, really prepared coming into the meeting. And there's meetings you have where everything just clicks and you're just super excited about the company. What I would say what founders can do, I think one thing you can certainly do is like maybe just prepare the investor a little bit. You can send them a deck, you can send them maybe some quick notes about the business that at least coming in, they have a little bit of context on the conversation. And then, what really gets me personally excited is just sharing a bit more about the background and how that connects to this particular problem that the founder is going after, and how they've, thoughtfully built a team to go execute, on this particular business that they're going after, and then connecting, having some kind of broader vision, because, as investors, we're invested in companies. A lot of times they're sub $10 million in revenue, and we're expecting this business to grow to $200 million in revenue. So I really like to hear a vision for how founders are going to take the business from where it is today to kind of multi-$100 million business, and that's going to involve potentially new products, potentially new markets, potentially new go-to-market motion. So I like to hear that the founders have some type of vision, right? That's grand and that they're driving towards, because that's going to help rally investors, help rally customers, help rally employees as well. And then because we're investors, there's a financial aspect to everything that we do. One area where I see founders sometimes maybe miss a step is sometimes people don't really know their numbers. I think that can be very challenging when you're having a conversation with an investor, not to know maybe what your business is, revenue or AR-wise, or not to be sure of like certain high level key metrics that investors will be looking to discuss with you, right, on an initial call. And then honestly, again, I think especially in the world of Zoom, I think really just being engaged, being interested, showing high energy on the calls. If you're, if the founder is, seems like very tired, and I look, of course, there's a lot of things going on in your professional and personal life. So this is definitely going to happen. It definitely happens to me. But bringing some energy into those conversations, into those pitches, with the founder, right? It's going to transmit, like, certainly. And so I think that sometimes, if you sometimes come out of a conversation, it's just like that drained energy, that sucked energy, right? Versus it got you excited, got you pumped about the business, about the market, about what the founder is building. So I'd say, yeah, this is some being able to tell that story from a prior background to a team, to why this problem, to the grander vision, and then knowing your metrics, knowing your numbers, having an ask, right? I want to raise X amount of dollars. This is the kind of investment I'm looking to add. This is what I'm looking for in an investor. Really knowing what you want and knowing your business, I think is extremely helpful. And the things that are, the things that can make that pitch not land as well is going to be, again, where people maybe don't know their numbers, they can't answer certain questions about their business. They're not really channeling energy or excitement about the business they're building, at that particular point in time. And I would say, finally, I think it's good to have the best pitches. I think always have like clarity around some ask, right? Whether, hey, we're raising X amount from this kind of investor. This is what we're looking for. I think it's always great if you can land the call with some kind of very clear cut, ask with the investor. But sometimes you're not fundraising, which is fine. In which case, you can be clear about that as well.
Yeah, no, I mean, that's a lot of good stuff out of that. I think the takeaways is know your unit economics and be able to tell a clear story about the business, have energy, show some excitement, and make the most of the opportunity that they have in pitching you. And it's actually, almost a plug for early growth as well. So that's exactly what we're focused on doing, is getting that story from a financial perspective dialed in, so that when you do get a FaceTime with your external stakeholders and investors, that that the numbers make sense and the story aligns with those numbers. So great answer. Will you give me an example of like an investment that you've made that has gone really well, and what were the key drivers of that? And then I think more interestingly is, give us an example of an investment that didn't go as well, and talk to me about how you handled that and what you kind of learned from that situation.
Yeah, maybe I'm still so early in my venture. Venture investments take many years to mature, so they take 10 plus years to mature. And so I would say, like, up to this point, most of my investments have done well, right? They're either they're raising up rounds, or they've sold the business to an acquirer, as well, which is great, because sometimes the exit is going to be like an M&A type exit. To date, I personally have not had a single business that just completely shut down and didn't return any kind of capital to investors. But that definitely happens, especially when you're an earlier stage investor. So I think this is maybe one of the unique things about growth investing, is that because you have so much more information, you're hopefully doing a better job of picking the companies that you want to work with and picking the ones that are doing well. But certainly in early stage, there's going to be a higher failure rate, because again, there's just less data, less information on those businesses. So I'd say I'll just go quantitatively. I love all my companies, so I don't want to like single any particular one out from the others as doing well or not. But the biggest company that I'm involved with today is a company called 6 Sense. So they raised a $200 million Series E round in 2021. They announced it this year, and they were valued at $5 billion in that round. So that's the biggest company that I work with from a size valuation perspective. And I think what they've really done well is, over the years, they've been able to put together a very strong management team. So the current CEO, Jason Zintak, he has experience working at a couple of large enterprise software businesses, and has been able to kind of bring that sales discipline as well to what he's doing at 6 Sense right now. 6 Sense is an account-based marketing company, and so what that means is that they're able to analyze a lot of data, that's a lot of the actions that people are taking on the web, So for example, if someone is searching for early growth, or they're searching for grants, or like any of the other kind of financial accounting providers, Six Sense can tell you that, hey, Demi from Sapphire is searching in your category, right? And maybe someone that you should be talking to, maybe someone that you send a marketing asset to, or someone that your salesperson should reach out to. So it can basically tell you, who's searching for your products, to where are they in that kind of sales funnel, like how interested are they based on the actions they're taking, and then it can help you orchestrate the right go-to-market actions to take. So if someone is very early in the funnel, maybe Six Sense might suggest you send them like a marketing, send them an invite to an event like this, right? But if the person is like deep in the process of comparing different vendors, and Six Sense might suggest that, hey, you have your salesperson reach out to that individual, or reach out to that company and call them, because they're right in the middle of making a decision. So that's what Six Sense does. Essentially, in 2020, 2021, the market for account-based marketing exploded, and every single company in that business just started to inflect and accelerate, because people were working from home, and so they were everything that they were doing was happening online. So any tools they needed to purchase, right, is something that they'd have to go online to search for, and just people couldn't meet in person anymore, right? So you needed to have like additional sources of data to understand who's looking into your category, to what extent are they, how deep are they in that funnel in the process of researching for your category, and therefore like what should you do to convert them as quickly as possible. So the market for account-based marketing really just exploded in 2020, 2021, and if you look at those 2 years, you see that almost every single company in the account-based marketing space raised a new round of funding, because the rising tide was lifting every single boat. And then with Six Sense, after we did a lot of customer calls, what we learned was that Six Sense was a much more differentiated player than the other companies that were out there. They're able to do a better job of identifying who's out there looking for your product. They're able to paint a vision of how they can also orchestrate your downstream go-to-market tools. So really connecting the dots between, hey, Demi is looking for financial services or CFO services, to, okay, this is what you should do because Demi's at a particular stage of his kind of research process. They were really able to like kind of connect those dots, not just giving you insights, but also actually helping to orchestrate the actions that you should take on those insights as well. So they were able to paint a very strong vision for that, and frankly they've really executed on that. If you look at Six Sense, they've acquired several companies like Slintel, like SalesWhale, to really kind of build out and execute on that vision that they laid out for us. So I'd say that these are the core reasons why: a better product, and then just a broader vision that they've been executing on over the last 2 years.
Awesome. Yeah, it's funny. I actually have been getting emails from an SDR at Six Sense. So
there you go. They're doing their job.
They're doing their job. Yeah. Knowing that they're one of your portfolio companies, I'll have to tee up a meeting with them and see if we can incorporate. That's all. Love the example, and yeah, I love the example. And it's not it's not every answer we get from a VC that they really haven't had a lot of failure in their investment. So
yeah, there's definitely some over 20 years, like you definitely have some of those for sure. I think early on your companies are still they're still evolving, growing. And so I'm fortunate to be in that spot, but certainly over 20, 30 years, there'll be some things that don't work out. And at Sapphire, we're again a long-term supporter of every single company that we're backers of. I mean, there's been an example in our portfolio of a company that I think they didn't maybe raise any capital for maybe upwards of like 5, 6, 7 years, and then with the pandemic, they were fortunate, they were a beneficiary of the pandemic because everything went online. And so we stepped up, like we'd been in the company for 10 years in total, I think, at that point, and we stepped up to lead the next round. So things are going well, great. We want to things are not going well. We want to make sure that we're in the trenches as well with the CEO, with the management team, helping them figure things out there. And it's interesting, I look at a lot of my partners, they've been around 10, 20 years. They have some companies that maybe are not doing as well as before, and they're probably spending majority of their time with those companies, really trying to make sure that they are able to find the home and able to kind of exit in a manner that works out for everyone.
Yeah, no, I mean, great success. And I think that's one of the beauties of kind of getting in at the later stages is you already have product market fit. The company, it has something tangible at that point. So obviously they're going to be around a little bit longer and probably a little bit longer life cycle than a seed stage investment might fizzle out a little bit earlier. So hopefully I can ask you in 20 years from now, and I'm sure you'll have a different answer and some more more to lean on. I'm getting a lot of questions about like specific companies or verticals, and would you look into those? So I think that's a nice segue to the next question of, what excites you? It seems like from looking at the investments you've made at Sapphire that, predominantly you're focused on B2B SaaS, but, talk to us a little bit about some of the sectors that really get you excited, and, would you be open to doing like a healthcare SaaS hardware play, and what are kind of the limits of
I
the
can
things?
tell you that quickly. Basically, we invest in application software companies, infrastructure software companies, fintech and crypto companies. All the companies we invest in are all B2B focused, so we don't do any like consumer facing companies. And we really don't invest much in hardware. I can't really think of any company other than a company called Tonal, so that's probably like an exception anomaly. But we really don't invest in hardware companies for the most part. But anything software, whether it's in healthcare, whether it's in supply chain, whether it's in retail, CPG, legal sector, definitely will do anything in the software space for sure.
Okay. So last question, I think there's a lot of uncertainty right now in the market. Are you guys very active? Are you slowing down? Like, what's your horizon over the next, your outlook for the next 12 to 18 months? And are you bullish? Are you waiting and holding your breath?
We're pretty excited about them. Look, it's 2021. I like to say was a bit of an anomaly, and we swung very much the other way in 2022 because of inflation and the actions that the Federal Reserve is taking. I mean, if you looked at the public markets last year, a lot of your favorite stocks are down 5 to 10% because of inflation concerns. But we're very active. We put out, I was on a team. We put out a term sheet, in the past 2 to 3 weeks. So we're actually looking at opportunities, and we'll bid on those opportunities if we can see eye to eye on valuation and where the business should be in the coming months. What I find in growth, which is again unique to us as growth stage investors, what I find in growth is that there's just a little bit of like not a standoff, but like essentially you have a chasm, right? A lot of growth stage companies raised a lot of money in 2021, so that means they don't need to raise capital in 2022 because of course in the first half of the year everyone's been tightening their belts, cutting spend wherever they can, so they're actually going to make the money they have last as long as possible. And then so there's one is like they don't actually quite need to raise money because they've raised a lot of money previously and they're going to make that money last because they've seen the economic environment as well. Secondly, valuations, right? So things were priced in 2021 is just not where they're going to be priced in 2022 because the public markets have corrected from a valuation perspective. And so a lot of companies are still growing into their valuation. Like they don't have the financials yet to support the valuation that they raised at in 2021. And so they need a little bit more time to grow into that valuation that they raised in 2021. So overall, what that means is you're going to have fewer companies raising. There's going to be a smaller top of funnel, essentially. But for us, that is just what it is from a market perspective. But whichever comes actually out there raising, we're open for business. We're bidding on opportunities all the time, and we'll continue to look at companies as they start to come out and fundraise more actively again.
Awesome. No, that's good to hear that you're still very active and bullish in the future. And that's gonna segue to the last question that I have. And I've seen everybody's chats. How's the best way to get in touch with you? Do you respond to cold outreach if it's curated? Do you like warm introductions from people
Honestly, yeah, I'm on email and I'm on LinkedIn all the time. Most probably the best way because LinkedIn has just a lot of spam on LinkedIn. But yeah, I'm on email. David has my email. I think probably most of these are your clients or people in your program. So yeah, if you see a company that looks like a great fit, David can always help introduce us, and he has my email. I can help to make those connections.
Yeah, happy to take a look at your pitch decks. If anyone wants to get in touch with me, I'll drop my email in the chat box, and I can look over the pitch deck and executive summary, give you feedback. And then if we feel like it might be a fit for Demi, happy to shoot it over to him to take a look. Demi, really appreciate your time. This has been really fun. I know you're sitting in the middle of a SaaStr event, and you probably have a bunch of meetings coming up after this that you'd like to prepare for. So thank you so much for your time. I hope we can do this again, and enjoy the rest of your day.
Thank you, David. Thank you, Kushbu. Great. Thank you so much for organizing and putting this together, and hopefully it was helpful to everyone in the audience as well. And thanks a lot to our partners too for putting this up. And yeah, so I think someone put in my email. So yeah, if you have any questions, just feel free to email me. And David, if for whatever, there's 50 something of you, so for whatever reason I didn't get back to you on time, also feel free to reach out through David, as well. And I'd be happy to connect.
Awesome. Well, we appreciate your time. Enjoy the rest of SaaStr, and hopefully we talk soon. Take care, Demi. Thanks, everybody.
Thanks, David.
Thank you
Take
so
care.
much. Thank you, everyone.
Bye now.